All right, hello everyone, and welcome to the Talos webinar covering crypto derivatives. My name is Kyle Downey. I'm the head of the portfolio management systems business here at Talos. I'm going to be taking you through both the Q&A on the market, but also a demo of the Talos PMS and its features specifically for crypto derivatives. With me today is Neelab Dixit, our head of product strategy at Talos. So we're going to dive right into it, and we're going to start with really looking back on 2024. So we've seen a lot of change in the crypto market, but also specifically in the options market. So Neelab, just tell us a little bit about really the landscape since January.
Sure. As we were approaching 2024, end of last year, beginning of this year, the markets were quite bullish and looking forward to the anticipated ETF launch. But looking back, from October 2023 to January 2024, the BTC volatility vol just went up from sub 40 to 70s just before the ETF launch. And people were there was a debate in the market where people were saying the vol has shot too much. But effectively, there was we were heading into an event that was unprecedented. There was an expectation of inflows, but I think most of the market, in a pleasant way, was surprised by both the scale and the speed of the growth. And ETFs have been a key factor of surge in adoption, in this year. Looking at the year, March and November were the months that were that saw highest volumes across venues. But if I look back into March, BTC broke all-time high, and then in November it printed a fresh high again. But what is particularly interesting is that when I'm comparing the volumes of March versus, let's say, November, if you look at the spot exchange volumes and the future props exchange volumes, March versus November across venues in crypto native exchanges, the quantum of increase is not the same as the quantum of the price appreciation. However, the real growth has been seen in ETFs. We've seen that in CME futures and the options market, both in crypto venues as well as hybrid options. That thing traded 1.9 billion USD on its first day. So that's a quick download on how I look into the year in terms of the growth pockets.
And one of the patterns that kind of comes out of that has really been the entrance of traditional institutions into the space, really at size in some of these markets, not just the ETF markets, but in CME. And others have observed that for entering the crypto market, kind of getting in your head around the sort of range of in the token space and kind of figuring out valuation models, et cetera, for that, and how do you invest there, has sometimes been challenging. But volatility is something that's very well understood across many asset classes. But still, there's some distinct pain points in this market that people particularly look at in terms of crypto derivatives. So could you just take us through, particularly given your past experience as a crypto derivatives trader, what are kind of the unique pain points that you see in this market?
Sure. The market is still nascent, in terms of the evolution. If you compare it with the traditional markets, which have been around for a large duration of time and are far more sophisticated, evolved. So there are multiple things to talk about. But the first thing is the liquidity in the market is still fragmented. So what that means is as a trader, you have to connect to various venues and be in a lookout of you have to build systems to be able to tap into the liquidity across venues. But along with this problem, there is another problem that comes up, which is counterparty risk. Because you're trying to optimize for liquidity, you are also taking the associated counterparty risk. So it's always an optimization problem to begin with, in terms of liquidity versus counterparty risk. That's one of the first problems. So I would want to understand what type of tooling you think would be useful to the people. I can talk about my thoughts, but would be good to know what are you guys building around it.
Sure. So you can already, in the treasury views for Talos today, see a combination of your balance exposure, so the capital you have at risk across any of the 60 plus connected trading, OTC, and custody venues that we support. So that first off kind of gives you that picture of where, say, you've posted margin, where you have collateral for derivatives instruments, or just generally where you're exposed if an exchange or even a custodian were to go down. We are also, with this release, adding equity views that layer on top of that the overall equity that you have specifically on the derivatives exchanges, so including the unrealized P&L that you have on contracts. So this gives you both a sense of how much equity you have from sort of a liquidation risk and margin monitoring perspective, but also a sense of sort of a potential loss of P&L in the case of unrealized P&L that you have on exchanges if that exchange were to go down temporarily or God forbid, permanently. So this is certainly something we saw quite a while ago post FTX, a lot more focus on counterparty risk reporting. So that is kind of available out of the box. And it's definitely more that we're going to be looking to do as sort of we add more models to get a more refined sense of sort of almost probabilistically what do you really have at risk at any given moment across all of these different exchanges. And the other thing that's kind of worth pointing out, which you alluded to, is part of that challenge is simply just getting the data in a normal form across all of those different venues. And that is something that we're building on top of with the Talos PMS, using all of Talos's existing connectivity. But yeah, I'd love to hear sort of further reflections from you on that and how that is kind of played out in terms of the market structure.
So actually, that brings me to the next topic that we might want to discuss as well, like before we head into the next one, which is just how the evolution of crypto markets has been. Like none of the exchanges or venues had banking licenses. Because of that, they could not like do margining in fiat. So they started like creating derivatives that are margin and settled in the form of stable coins, first with like coin margin. That's like how inverse coin margin first came in. And then as stable coins grew, you had stablecoin derivatives. Now, what this brings is like it brings complexity in terms of how the P&L is calculated, and also like how it affects your risk. So, like going back to your point, like not only it's important to aggregate to have an aggregated or non-normalized view across venues, but it's also about instrument types, because you have a variety of instrument types that have different payoffs or different payoffs in terms of settlement currency that brings in like different form of P&L and associated delta risk. And being able to, as a trader, like being able to decompose your P&L, know your drivers of the risk is extremely important, because you make decisions based on that. And yeah, like post FTX, we've been seeing that markets are moving towards more of off-exchange settlement, but it's still an early phase of the adoption, as a major portion of the crypto markets are still like basically they're still managing their balances by themselves. Even if a trading firm has like is using a custodian solution, they're still like creating the transfers by themselves. And what happens is like they are always on an optimization problem that earlier I said, like finding the best liquidity, but utilizing your balance sheet to the most like maximizing its usage. And I think like a consolidated view and tooling around looking at your balances, equities, and as well as like basically being able to like take care of the settlement is extremely important. Like these are the foundational pain points that you get into if you, let's say, move like from a trader seat in a TradFi market to coming into crypto outside of volatility and other market risk factors.
Yeah, it's a really good point. I mean, there are kind of two types of normalization that you have to deal with. One is sort of normalization of your risk P&L position representation, and the other one is across just all these connections that you have to make and integrating all that data together. And the inverse payoffs are, it was a product innovation, kind of dealing with the problem of, not having access to fiat. And it's been one that has been very successful. But it does introduce, additional modeling challenges in terms of, you're starting to pull in gamma. You have elements of convexity in those payoffs that, like just a standard cash-based instrument, you may not see that. And one of the things that we did as part of the first version of the Talos PMS with the risk pivot was trying to sort of unify all those risks across the different buckets. So it doesn't really matter where it's coming from, and the ultimate view is that should apply across a wider and wider range of instruments, whether it's DeFi or crypto-backed traditional instruments, to kind of show all those Greeks together and then ultimately to decompose and explain the P&L in terms of all those Greeks all the way up to sort of stress testing as well. So, one of the things that we have to deal with, and it's sort of helpful to have that layer between you and the market, is that things are moving quickly. And you kind of mentioned the regulatory drivers as well, like that landscape is changing. You're having some exchanges moving toward a more regulated environment that may cause flows and liquidity to move toward those venues. You still have these pressures of people trying to diversify across them that is causing some of the exchanges to grow in volumes at the expense of Deribit as the leader in this space, just due to concerns about that concentration risk. So that in that sort of fast-moving environment, whether it's sort of novel products or instruments being developed or novel venues, like you need to move quickly. So one of those areas of, I would say, still uncertainty, although there's been a lot of really great developments, a lot of great work post FTX on this. You alluded to briefly, and I think it's a really good point. This is sort of not a silver bullet, but it is an improvement in the structure of the market, which is these sort of off-exchange mechanisms for custody and settlement. So tell us a little bit about that landscape and some of the new things that have come online this year, and some of the things that you're excited about coming up.
Sure. Like on that front, like on the like post FTX learnings, importance of like credit counterparty risk. The industry has been developing or moving towards off-exchange settlement, where like more and more custody providers or custody solution providers or custodians have started offering it, where there is like it's a tri-party agreement between your custody solution provider, yourself as the user, and the exchange, where the balances actually sit on the custody solution, not on the exchange, and they are, however, effectively they are providing credits to the exchange so that they can settle and they know your margin or pre-buying power before you enter a trade or once you have an open position to support it. But it's still early days, like as in like it will take a while for the adoption to basically to scale. The other thing that is interesting is like since then we've been seeing the growth of like prime brokers, which is like lending is a backbone, like leverage is backbone to trading, and that's we've seen like massive growth on that side, but that's still just like off exchange settlement, that is also in its nascent stage relatively, where like there is a lot more work or a lot more risk capital that needs to come in to start seeing the type, like if you were to replicate, like bring an analogy towards like TradFi markets, now going more towards like 2025. If we look back at traditional markets, like if I just look at, I feel like the growth potential on crypto derivatives is quite a lot, and that's what I'm looking forward to. For example, in the US, like I think I read it from like few of the articles where like the volume of SPX options compared to the underlying is like 20 to 25 times. And if you compare that with crypto, like even if Deribit last like in November traded like 100 billion USD a month, it's still a fraction, like it's few percentage points of the total spot volume traded. So the quantum of growth there is like huge. And as we see, so just it's been a short duration since IBIT options have been launched, but just looking at their debut day, like trading like such a large volume, I think that like getting these and CME options also taking an uptick, I think they will continue to drive the like derivatives market growth. Another like interest of like development would be like around ETFs, where you might start having more than a single underlying asset ETF, like effectively having a basket. I think that would change the market structure as well. But effectively, like I'm looking forward to the derivatives market as the main growth pocket. And I'm really excited about the tooling that we are building around it, because you have to solve for two things. You have to solve for liquidity, but at the same time, you also have to solve for PMS. Like TMS to me is the backbone of all the trading decisions that you make in terms of like managing your risk, or like going up or higher, like higher or lower in terms of the risk taking. So would be great if you can talk about more about what we have and what we are looking to build as we
Yeah,
go into the
sure.
next year.
And I think at this point, it's probably good for us to switch over and start going through actually what the product looks like today, and how you can already use it to kind of solve some of these pain points, with really more to come. So right now, we have really three different primary views that we offer, and this is all fully integrated with Talos for trading purposes as well. And we really think about this sort of in terms of front, middle, and back office needs. So we're looking at the portfolio management view, which is like really focused on position and P&L views, sort of start of day. Where do you stand in terms of positions in whatever strategies you're running? All of this is based on top of our IBOR, our sort of books and records system, which offers its own representation of sort of how your fund is structured, or trading desk, or whatever set of synthetic accounts you have for booking purposes. So we're kind of looking at a demo hedge fund right now that's sort of a multi-strategy setup that does pull together spot futures, perpetuals, and options. And we're focused in on the vol fund, but we could jump around and say, look at delta neutral as well, all in one place. And so for this initial view, sort of we're just getting that high level of where we are according to the model in terms of our overall delta exposure, what's our 24-hour P&L, and we can kind of view that rolled up across all of the strategies, if we will, within the fund, or we can focus in on one. So, Nilab was speaking earlier about the challenges around P&L and the range of products. We have relatively simple deribit option products represented here, but we have the full breakout. So the models that this is based on are currently running every hour, calibrated out of deribit for volatility surfaces and yield curves. And we're using that to sort of compute not just sort of your overall delta exposure, but the full range of Greeks. And then on the P&L side, we have the full breakout, realized, unrealized fees. We don't have funding pulled in here, but we have funding P&L as well. And because we're building this all on top of that wide range of connectivity, sort of normalizing all of those cash flows coming in, events, trades, et cetera, and building up and then reconciling those balances so you have a lockdown view of everything in your portfolio, we can then periodically snap and provide all sorts of windowed P&L as well. So 24 hours, 7-day, 30-day, et cetera. And if that view is sort of not fine-grained enough for you, you can kind of go to the historical reporting that we have as well that's building on top of that, pick any moment in time, and see sort of our opening and interval P&L for that particular moment, and then zero in and kind of see the position. And importantly, out of all of this, sort of these overviews, getting that point of normalization, at no point did we have to care about whether we were trading these options or perps on Bybit or Binance or Deribit. This is sort of a unified net view structured in the way that kind of makes sense for the asset manager or the trading desk, rather than just the specifics of how things are, happen to be set up on exchanges. And this is particularly important in the risk view. So we were talking earlier about the richness of payoffs that we have in the space. But the reality is that at the end of the day, a lot of these are exposed to common risk drivers. And really, from a risk management perspective, what we want to be doing is we want to normalize that. We want to see sort of our delta, gamma, vega, vana, the full range of Greeks available from the model, say how much theta decay you have for a given day step in the fund, regardless of what type of instrument we're talking about here. And if you do want the details, you can drill in, use the instrument inspector, and you can get everything from sort of the mark price in the model, the implied volatility, all the way down to sort of the deribit convention raw Greeks for every single derivatives instrument in the portfolio. And of course, it'll pull in the Greeks that are applicable for that instrument. So we have the full range here for this particular deribit option for December. As Nilab mentioned, when we talk about risk here, like we've spoken a little bit about sort of credit and counterparty risk, we've spoken about market risk, but operational risk is always a big part, particularly in a nascent market like the credit derivatives market. So the operations view gives you a similar unified way of dealing with all of the connections that you have. So this is where you get that overall view of sort of balances versus equity. With the latest release of the Talos PMS, we added in that equity view. But from here as well, you can also manage it. You can initiate deposits and withdrawals through Fireblocks. You can initiate settlement as well if you're dealing with OTC counterparties. So, it's as much about ensuring you sort of have your balances in the right place to protect against liquidation risk as it is about sort of understanding the dynamics of the market. So this system is fully in production today. It's available to several of Talos's clients, and a growing number are starting to adopt it. We'll be talking a little bit in the next section about kind of the future of this, but this shows you what you already have today, that sort of unified view across spot, futures, perpetuals, and options, bringing together the position, risk, P&L, as well as the operational elements all in one place. So, for the next section, want to kind of swing back and really look to the future here. So, for what's coming, we spent a lot of time on 2024 and started to touch on some new developments that you were excited about, Nilab. I'd love to hear about what other things that you see developing. We really are still at the early stages in this fast-growing market.
Yeah, I think like more from the, let's say, from risk PMS perspective, outside of the theme will continue to be the growth pockets are these derivative markets and the access to TradFi through TradFi like regulated markets. But effectively what it would bring is like more complexity and more like will demand more needs. So like let's say if you are a TradFi firm, or if you are like any seasoned trader who's now entering crypto, like what would be your natural like way to set up? Like the natural like path would be like first you will set up for your custody where you can keep your assets, unless you are just trading on like CME or just regulated venues where like you can margin and settle your trades in fiat through an FCM or a prime broker. The second step would be like selection of the venues that you will be trading in. Third would be like having a way, as you highlighted earlier, like the emphasis on like having an aggregated view of your balances and exposure tracking. And then on top of that, like you'll have to have a very solid PMS. By solid PMS, I mean that like, yes, a lot of firms within the markets like are either building it as a solution for the trading firms, or some trading firms have developed in-house. But the state is still like, if you compare it with the TradFi, like we're still far behind in terms of the richness. But the TradFi like institutions, when they come in, they would expect they would demand for the same level of richness. So I think that would be the key. And once you get that the way you get comfortable with the risk is like you get comfortable with risk taking, also with your tooling. So once you get into that stage, then you build in the risk confidence, and then you go for like sizing up in terms of the risk on your alpha generation. So that is a sequence that I'll see. That's how I'm thinking about. Like if we are thinking about the growth driven by institutional players going into the next year, uh, there are few interesting things that it brings in, like which we can talk about. Uh, as like so, for an instance, like as you said, different venues, like not only like yes, you need to know your equity, your balance, your P&L across different venues, your exposures, but also you might be on different margining modes across exchanges, and exchanges don't know about each other. So they even if they have like a great tooling to replicate scenarios like on your P&L, on your risk, on your margin requirements, but they don't know what about other venues. You need an aggregated view. Uh, like IBIT options are American style. They settle physically, meaning that like you have to exchange it in terms of the shares. Uh, until now, like derivative options and CME options were all called cash settled. So you need basically a robust PMS that is able to price these instruments, show your correct risk, and take care of the cash flows. And I think those are the most important things looking forward to before we see next quantum of size in the volumes on the derivative markets.
And as some of those new players come in, I think they're going to be bringing expectations from kind of traditional structure, as well as building on what is already out there. And we touched on kind of the off exchange settlement and sort of basics on margin posting, but like one thing that I'm personally excited to like see some standards convergence and kind of move toward a shared market structure is acceptable yield bearing collateral in the space. Like this is something that I think for anyone coming from a conventional derivatives exchange is a little bit surprising, that you're generally not posting cash. And if you're actually holding these instruments, you would prefer, in a conventional sense, treasuries. But we see a number of initiatives in the market of people developing yield-bearing collateral, announcing partnerships with exchanges, and so that's something in terms of the overall landscape of what we're building, we're still kind of keeping our eye on where things are headed. And some of these things haven't necessarily converged yet, but there are signs that we're heading that way. And so we're looking to build sort of not just the attribution across say your unrealized P&L on your derivatives positions and all that breakdown and the breakdown by Greeks, but also pulling in your staking yield and how much yield you're maybe getting from a tokenized money market fund. So you have that all in one place. And of course, as we get standards around settlement and clearing as well, it is definitely going to be helpful for market participants to not necessarily have to care about the details of those integrations, because right now the kind of early offerings in that space, they have all taken a somewhat different approach to it, and they've partnered with different people. So having a single view that kind of cuts across all of those, I think, will be really helpful in the market. And I agree with you. We're gonna see as people get more comfortable, moves up the risk curve, and that's going to lead to greater demands. So what we have right now around margin management and margin monitoring kind of pulls together and at least gives you like a single view of what the exchanges are offering in terms of initial margin and maintenance margin and equity. But if you really want true protection and you want a true sense of what kind of liquidation risk you're facing, and if you want to actively manage that, there's a lot more that you need. One thing we haven't talked about is the importance of push notifications, like just when there is a condition, like say distance to liquidation has dropped below a certain level, having that in-app, Slack, Telegram, etc., so people can actively intervene is something talking to clients is incredibly important. And the more you're trading across a 24/7 market, the more you're going to need the system to be pushing what you need in the moment to you. And that sort of development in the risk space, like sort of moving out the risk curve, widening of products, this isn't gonna slow down at all. We will be adding in first initially just the standard OTC instruments, but you and I have talked a lot about the fact that is a very small subset of the richness of available derivatives instruments, and they demand a lot more in terms of the modeling, in terms of pricing control. So whether it's structured products or just simple barrier options, being able to handle those more sophisticated payoffs without having to jump out of that single PMS view is something we're going to be looking to. So I'd love to hear your perspective on like product instruments of interest and arcs where you see things heading, maybe as kind of a way of addressing some of those concerns in terms of counterparty risk, but also as a way of tapping into different risks than are available in the listed space today.
Yeah, so Debit continues to be the most liquid options when you CME options have seen their like fair share in terms of the growth, but IBIT options has really surprised and again a pleasant way in terms of like the traction. Very early days, but we'll see how it goes in few months. They will bring some growth on the OTC markets as well, like pre-FTX structured product markets, like in certain regions all over the world, and were like basically were reasonably big. And now like if you have like a well functioning option market, like you'll see like growth of OTC derivatives, you will see the growth of structured products. So what that means is now if the listed venue still will continue to be the source for like pricing and replication of payoffs, or for hedging, not a perfect hedge, but trying to replicate either of like payoff plus the risk. It will bring in the demands like or the needs for a lot of like tooling. So for a very simple example, let's say you are a dealer who runs an OTC derivatives book facing clients, and your clients are like miners or basically firms that require like downside protection or looking for an yield above whatever they hold in terms of their crypto holdings. And you are like offering them these products which are physically settled, and you're replicating the payoffs through Deribit. What happens is like going into the expiry, like because one is physically settled while the other one is cash settled, post expiry you will have to still like do some trading. So having like a good like just like a good scenario tool which helps you, especially on the days when you are pinned in terms of their risk, understanding how much like physical you'll have to trade out going through the expiry so that you don't have to pay up a further like spread above like after expiry to get out of it, would be something interesting. And now like if we have American style options, the premiums will be higher. Like you'll have a different way of like modeling them. You will need like more richness in terms of your model and your risk management tools. So yeah, like in short, like it's basically about cash flows, about risk pricing. That's how I'm looking at for in terms of like variety of instruments, from just the listed instruments, European style cash settle and Bitcoin, Ethereum terms, to CME, to IBIT, that is American and physically settled, to OTC derivatives in structured products.
And it's a really good point. Like we're running a desk and you have OTC, but then you're hedging out the back, in the lit markets, whether it's on Deribit or CME or anywhere else. Like you need to be able to connect those two views. So you need that ability to price those more sophisticated payoffs, but also represent the hedges that are on the other side and get a unified view of that risk. So, by building the OTC capabilities on top of the already very strong support on the listed side, this is going to give us that unified view. And once you have those more sophisticated payoffs, like, you can only get so far with auto fitting off of Deribet. You start to introduce more sophisticated pricing controls, whether it's vol bumps or rate bumps, ability to bring in your own calibrations. So all these things, with the enhancements to the pricer, a lot of this is going to be about fine-tuning of the pricing, as well as introducing the models that build on top of those new pricing mechanisms. We're also going to be expanding our reporting to include conditional VAR with full risk attribution down to the various risk drivers, stress testing, attributing shocks to those same spot, vol, and basis drivers. And then, you touched on earlier the importance of P&L explain. We have the breakdown to sort of your basic P&L drivers already for attribution purposes. But really what you want to start to understand is to what degree are different risk drivers driving your P&L today. And that really requires a Greek-based P&L explain. So all the models have been built really to be foundations for this much more sophisticated risk and P&L attribution. And absolutely, we are alive to the operational challenges that come, sort of the mechanisms that we have for OTC settlement today, and the mechanisms that are integrated with the exchanges. A lot of this leans on the exchanges taking care of those calculations, taking care of those notifications, delivering the cash flows, et cetera. In an OTC world where you're juggling that view and your own OTC, you need a lot more tooling. So that's something that we're excited about as well. But the real bottom line here is, I think both of us agree that this is just the beginning for the crypto derivatives market. Like, it is so clearly undersized relative even just to the traditional analogs. We know we're going to see massive growth in this space. And so just that alone is exciting, getting these tools in the hands of people who are jumping into the market, as well as, people who've been dealing with now for years some of these challenges, whether it's with in-house systems or spreadsheets or whatever. Finally getting that single view in one place should help everyone keep pace with that growth. So, as we kind of draw to a close here, one thing I just wanted to ask those of you who've stayed with us to the end, and thank you for that, is just to let you know that we are not only continuing to build here at Talos, but we're also actively seeking design partners to work with us. This is a chance to actually shape this vision. We talked about some of the pain points that are we've seen and that we're hearing about talking to clients, but we would love to hear directly from you about, does that resonate? What other pain points are you seeing? So we can really get a solution that works across the market in this sort of rich and fast growing space. So we have plenty of materials online, or you can reach out to myself, to Nilab, or to our sales and account management teams to learn more about what we already have today at Talos and what is coming in 2025. So thanks, Nilab. It's always a pleasure geeking out about the options market and derivatives more broadly with you. For those of you who joined us, thank you for taking the time today to learn more about what we have at Talos and the state and future of the crypto derivatives.